Yes.
Okay, so uh, let's get started. Yeah, so today we are talking about bonds. So everybody knows pretty much about equity. That's a glamour world. Things are happening daily there. Um, Stock market moving up and down like anything. So that's a happening place. Everybody knows about equities. Everybody wants to invest in equities and earn quick money or get as much as returns as one can. So that's fairly known territory. Then there is another instrument, fixed deposits. Everybody knows about it. That's a traditional way of investing. People have been investing in fixed deposits since several years, and that's a safe avenue for people to park their money or surplus funds. So basically, what we do in fixed deposits, we lend money to the bank, and they, in the return, they assure us certain percentage as an interest. So for example, if we go to State Bank of India and deposit 1 lakh rupee, and they assure us that, okay, you keep the money with us for 1 year, we will give you 7% return on that money, and that's fairly guaranteed. Uh, your money is not going to go anywhere. At the end of the maturity, you are going to get your money along with the interest. So, what are bonds then? Let's see. So, here we talked about investing money in mix of equity and fixed deposits. In equity, it's a high risk, high return investment option where we can expect around 15% return. Though I still consider 15% on quite higher side. I expect my clients to plan for 12 to 13% maximum. Anything above that will always be better. But when you plan, when you do goal-based investing, planning with 13% is the optimum thing that I suggest. Then there comes fixed deposits or debt mutual funds, which give you around 7% returns. But if you factor in the taxation, then your returns further lower on fixed deposits and debt mutual funds. Of course, those are low risk, low return products, and those are good for certain demographic of people, for example, who are very conservative and who don't want to take risk. So for those people, the people who are in the retirement or who are approaching retirement, these are the safer avenues to invest their money so that your capital will remain safe. So basically, the first one, top one above, is the capital appreciation product, and the bottom one is capital preservation. So the bottom one is aimed at preserving your capital interests or the gains on that is secondary. The most important goal is to preserve your capital. So that's where fixed deposits and debt mutual funds fall. Now, in between, there is one category which we called as bonds. So bonds usually give us better return, not usually, almost always give us better return than fixed deposits. Those are not as risky as equity. Those are certainly low risk products and they give you higher returns compared to fixed deposits. So they are just like fixed deposits, but they are the difference is that there are different types of bonds. Some are issued by the government, like state governments or central governments, and some are issued by corporates, like major corporates. So what actually are bonds? I know you guys might be knowing it, but still I will explain. What do we do? These large corporates, say for example Reliance, Adani, and all these companies, they need money to run their business. So to raise the funds, they have various options. They can go and take a loan from bank, but when they need a large amount of money, they issue bonds. So bonds are like they give us the guarantee that you lend us the money, you give us the money, and in return we will give you certain percentage as an interest periodically. Say for example, if Reliance issues a bond and they agree to give us an interest of 8% per annum. So if you are investing 100 rupee with them and the maturity is 1 year, and if the uh, interest payment frequency is half yearly, then you will get 4 rupee after every 6 months, and at the maturity you will get the final interest amount plus your principal of 100 rupees. So that's how the bonds work. Uh, Government bonds are called as sovereign bonds, and those are the safest bonds. I mean, those are risk-free bonds. So one can assume that is a benchmark. I mean, if you lend the money to government, it's not going to go anywhere. You are for sure going to get it back, and that's why if there is a general rule, if there is a low risk, then returns are usually also lower. So if you see here for government issued bonds, we expect as on date the current returns at 7% because those are safe, and there is no risk of default there. If you go to the corporate spectrum, then of course there are different types of corporates which are considered as low risk, low credit risk, and certain corporates are high credit risk. It means that their business, they are not stable. If anything happens in economy, you might lose your money, and in that case, the risk is higher. But at the same time, they provide you higher returns in the range of 8 to 15%. So we will see about these bonds in upcoming slides. So this is basically bonds are low risk products provided you invest in uh, good rated bonds. What are the ratings we will see in the next slide. But those are less risky than equity and give more return than fixed deposit. So that is this untapped bond market. 4 to 5 years ago, only institutional investors were allowed by SEBI to invest in these corporate bonds, meaning people like you and me who are retail investors did not have any option to directly buy a bond from the corporate. However, I think 5 years back, SEBI allowed this investment by retail investors, and that's where it has given us an opportunity to get into the bond market. However, there is still a lack of awareness in the people that they can buy directly from the market. I don't know if you remember a few years back, there was a lot of hype about RBI retail bonds. They opened their own portal where you can buy government securities from that portal. So from there it started, and now corporate bonds are also available for retail investors, which is less known. So usually before we go to what bonds are, you might have heard about debt mutual funds. So what usually debt mutual funds do, they invest in these bonds only. Say for example, I'm talking about some debt mutual fund from ICICI. So what they do, they go and purchase different types of bonds from different corporates, and then whatever interest they get, they pass it on to us as retail investors. But then in the process, they keep some uh, fees for themselves, and ultimately we end up getting 1 or 2% less than what actually the bond has committed. So when we talk about bonds, what are bonds? Bonds are nothing but debt securities. Debt security means we are lending money to some um, entity, be it a corporate or government, and in return they are promising us to give a certain interest on that investment. So bonds are debt securities where an investor lends money to a borrower, in that case government or corporation, in exchange for periodic interest payments and the return of principal amount. At the end of the maturity, you will get whatever you have invested, the principal amount. These are held in demat form and these are listed on BSE and NSE. So the good thing is that these can be traded like shares. Like you can go to the BSE or NSE exchange, and if you want to sell your bond, you can do it just like any other equity share. Face value, so like IPOs, you must be knowing about the IPOs in equity. So there are also IPOs for bonds. So when bonds are issued for the first time in the primary market, what does primary market mean? When the corporate issues the bonds for the very first time, then that is called as issuance in primary market. So at that time they decide a face value. Say for example, the face value of one bond is 1000 rupee, and it is being issued in primary market, means I will go to that corporate, I will pay them 1000 rupees. In return, they say for example, promise me to pay 8% return. So I the face value of 1000 rupees with interest of 8%. It means that every year you will get 80 rupee if you buy one bond. So interest is always calculated on the face value of the bond, not on the current traded value. So what happens when you buy the bond from primary market? Say you buy it for 1000 rupee. So you hold it for 3 months, 4 months, 5 months, and you see, hey, I need some money, or you see that interest rates in the market are changing and you want to sell it. Okay, even if the maturity is 1 year, you can sell it in between. So how do you sell it? So you go to the BSE or NSE exchange, and you see that the interest rates in the market are falling. Say for example, the RBI interest rate cut happens and they say that now current interest rate is 7%, but you are already getting 8% in your bond investment. So you know that your bond is in demand because market is offering 7% return today and my bond is giving me 8%. And if you want to sell it, you will definitely get a premium because people, there will be demand for your bond to buy because it's giving higher return. So this is the equation. If interest rates fall in the market, your bond price increases. So in that case, even if you have bought the bond for 1,000 rupees, you can sell it for maybe 1,100 rupees, 1,100 because it's in demand, it's in premium. So that's how you make money in the bond market. If there are no buyers, then you hold it till maturity. At when the bond matures, automatically you will get the interest as well as whatever premium principal you have invested in that bond. So this is how usually the bonds work. But the important thing to note here is that the interest is always payable on the face value of the bond and not the current traded value. The coupon rate is nothing but the interest that the bond is committing you or promising you. So if you say you bought a bond at 8%, it means that it's a coupon rate on the face value. It is expressed as a percentage of the bond's face value. Again, this is the coupon rate on the face value of the bond, not on the traded value. So this is the interest that issuer promises to pay to the bondholder. So these are the common terminologies. So don't worry, as you get into the bonds market, this will be pretty clear to you guys. Maturity is the time until principal scheduled repay again to the investors. This is basically like any other fixed deposits. If you now open a fixed deposits account in any bank, and if you say you have opened it for 1 year maturity, at the end of 1 year you get your money back. Same thing here. If your bond has a maturity of 1 year, you will get your money back after 1 year. Now this is something important. This is called as ratings. So there are different rating agencies in India, like CRISIL, ICRA, and CARE. So they always keep following the market and the corporates, their stability, their ability to pay the interest to the bond holders. Based on that, they based on that they give rating to the bonds. So if you see AAA rating, that is the highest possible rating that any corporate can get. So highest safety, it means there are very less chances of default or that company denying you interest payments. So that's you can safely invest money in AAA rated bonds. However, safety comes with low returns. So if you search on the portals, if there is any AAA rated bond, you will get slightly lower interest than other bonds which have lower rating. So guys, am I clear? Am I going too fast, too slow? Please feel free to tell me if things are not clear. Okay. And try to, I mean, if you have any questions, try to stop me and ask. I want this to be an interactive session. I'm audible, right? Because I'm not able to see, I'm sharing my screen, so I'm not able to see anyone uh, here. Am
Yeah,
I?
yeah, you are audible.
Okay, okay,
Yes, audible.
okay. So this is how the rating usually works. So lower you go in this list, the chances of risk increases, but at the same time, the interest increases on those bonds. So usually, as we will definitely discuss in the upcoming slides, but usually I recommend my clients to stay in the A grade category only. So triple B, C, these are like very, you know, there are of course there are buyers for these categories. So who can invest in triple B, double B or these kinds of bonds? So say for example, if you have 100 rupee and if you are willing to put your 10 rupee at stake, you are comfortable losing that money, then go for triple B or C graded bonds. But if you want a better return than fixed deposit and you still want a good safety, double A, triple A, these are or A, these are the ratings that we recommend to the people. Again, the interest rates vary among these three categories also. There is further uh, granular categories in these three also. So if you see, for example, usually when you go and see a bond rating, you will see, for example, if it's a double A rated. So you can see double A plus, double A minus. It means in double A category also there is a better graded version which is double A plus and a slightly risky version which is double A minus. So this is how usually ratings work for the bonds. Any questions so far? Okay. Now, this is what we discussed opportunity. What are the opportunity in bonds? So FD investors can earn 2 to 3% additional risk-free returns through bonds. Now, when we say it's only 2%, 3%, why should I care? But when the amount is more and over the period, if you calculate this, it becomes quite a big amount. So if you invest prudently in a wise manner, bonds can give you certainly better returns by carrying less risk than equity. It does not mean that you should not invest in equity or other things, but this is just one asset class that you can certainly think of against fixed deposits. Retained bond investment set to explode with government and corporates keen on retail participation. Now, as I said earlier, this is a fairly new to investors because retail bond investment is permitted by SEBI just few years back. So there is still lack of awareness in people that they can directly buy corporate bonds, government bonds. So as and when people come to know and awareness increases, this bond market is definitely going to increase multifolds. So currently government has outstanding bonds of rupee 80 lakh crore in the market. They have already issued these many bonds. Corporate bond market is currently at 32 lakh crore and SEBI expects it to grow to 70 lakh crore by 2025, which is end of this year. Now, what are the unique set of benefits when we talk about the bonds? Again, predictable high yields in safe investments. What does predictable mean? If you get a bond, say for at 10% of interest return, whatever happens there in the market, let the stock market crash, let the economy crash, you will get 10% on your investment. That's a promise from the bond issuer, irrespective of what happens in the market, what happens to the interest and everything. So this is a promise. So it's like again a fixed deposits, whatever interest rate you lock in at the time of purchase, you are going to get it throughout the maturity. So usually you get additional 5% income over fixed deposits based on what type of bond you buy. Say for example, additional 5% mean if you invest 10 lakh, this 5% becomes 2.5 lakh in 5 years, which is a good amount. If you take a prudent decision and invest in bonds, you can, I mean, this is the difference. If for 10 lakh you can get 2.5 lakh additional compared to fixed deposits. There are also tax-free bonds available. So whatever interest you earn on these bonds are tax-free. You don't have to pay tax. But again, these are usually issued by public sector entities, and since there is a benefit of tax, these usually give you lower returns compared to corporate bonds. Collateral for business loans and trading margins. If you want to get a loan on your bond holdings, you can get that loan against your bonds. You can pledge your bonds and get the loan, and you can still keep getting the interest on those bonds. So that is one additional benefit of bonds, though I do not recommend to get loans by pledging bonds and equities. And there are different set of people who can do that, but for retails we do not recommend this. So Vijay, yeah, you have to say something, please. Hello, Vijay, you have your hand up.
He has posted his question in the chat, I guess.
Okay. Uh, Let me check. Okay, we'll go through that question at the end of the presentation. Let me check what are the. Yeah, so we will discuss. So at the end of this presentation, the typical ROI slabs, I will show you the portal that we are partner with, and I will walk you through different types of bonds available. Okay, your microphone is now okay. Okay, in new tax regime, yes, because see, whatever interest is your income, so you have to declare it, right? So that's actually a good question. Let me check how it works on the new tax regime. So I will come back about how exactly it works on new tax regime. Okay.
Hi, Pawan.
Hi.
Hi, good morning. Yes, I have one question. Like when you said that lock-in period can be done for the bond as well, how it can be calculated? Because I'm very
I
new
mean,
to
I
this.
mean, I mean the interest, right?
Correct, correct. You said that you will get a, let's say, fixed amount of interest at the end of 5 years,
Hmm.
and you can predefine that when you invest, right?
Yeah. So I will show you the portal. Things will be very clear because it's called as yield to maturity. So if you are buying from secondary market, say a 1,000 rupee bond, you are buying at say 950. It means that even if that bond is giving you 8% on the 1,000 rupees face value, you are buying it for 950. So you are getting additional advantage, right? So then it calculates yield to maturity. What is the yield to maturity? I will show you with examples. So that is there in the upcoming session. So that will get answered for sure.
Okay.
Okay. Yeah.
Thank you. Thank you.
Yeah. And retirement planning, save tax by opting for investment where the interest is earned post retirement. So this is basically well suited for the people who are approaching retirement or who are already in the retirement. If you buy highly rated bonds, you can certainly earn more interest than fixed deposits, and that is how it works. I will explain the term yield to maturity at the end of this presentation. And yes, one more thing, a lot of clients or people have questions that we have not heard about this thing. So is this regulated or what? Yes, so these are 100% regulated by SEBI. These are monitored by SEBI, and these bonds are listed on NSE and BSE. So it's not that you are buying it from some unregulated entity or anything. You, whatever platform we have partnered with, I will share it at the end of the presentation. You can go to SEBI, NSE, BSE website, check their credibility. They are listed there, and they are a part of an OBPP, which is called as Online Bond Provider Platforms. So there are around, I think, 22 platforms till date in India. Some are not operational, and there are 6 to 7 which are active in this bond market. So we have partnered with one of them, and I will show you how their portal works and how we can trade on that portal. So this entire process of bond issuance, rating, order processing, and money transfer is regulated by SEBI and managed by SEBI registered entities. So this is not latest as on today, but these are some type of bonds which were available last week in the portal. So these are just few examples. Say Edelweiss is one which is A plus company which is offering you 12.15% of yield. Now this is not a coupon rate. Okay, I explained earlier. This is not the interest that Edelweiss has promised. Sorry, but this is the yield that you will gain on your investment. Now, what is yield? I will explain in a bit. Maturity of this bond is 21st July 2026. So, if you invest 100 rupees today in this bond, you will get 12 rupee uh, per year, and you will get your principal back on 21st July 2026. Similar for Muthoot FinCorp, which is double A minus rated corporate, offering 10.65% with a maturity in June 2026. These are just few examples. These are again different types of bonds available out there, IIFL, Edelweiss, with different types of rating. Now, if you see this, Kirtana Finsure has triple B rating, but they're offering higher yield, which is 13.70. If you go to Motilal Oswal, this is a fairly stable organization with a good rating, so the yield you will see on a bit lower side. So this is how usually um, okay, your meeting will end in 10 minutes. So guys, if this meeting ends, please, this is a free version of Zoom. Please rejoin the meeting. I will extend the duration. This will abruptly end in 10 minutes. I can't do anything to extend. So please join it back again immediately. So again, the investments you can, if you want to try your hand, you can invest maybe 25,000, 50,000, and you can really feel that you are getting your interest in your account. So when we say when you make your hands dirty, then only you will learn how these things really work. So you can start with 25,000, 50,000, and start with double A or triple rated companies and see how these things work. Now, this is the platform Bond Bazaar that we have partner. I met their business operations director on Monday. I had a lot of discussions with them how they operate. I also evaluated a couple of other platforms, and I chose to go with this platform because this offer unique benefit that others don't offer. Uh, this offers you to exchange your bonds on NSE, BSE, as well as they have a concept called RFQ, request for quotation. So I will explain you what it is. So other platforms do not offer you to exchange your bonds on NSE BSE, at least the ones that I evaluated. So this is the unique feature in this platform. They also give you a terminal where you can directly trade your bonds in NSE and BSE. So there is a link here. I can share the link. These are NSE and BSE registered platform. You can find their details, registration details, and everything on these NSE BSE platforms and SEBI website. So this is a regulated platform. So this is the presentation before I take you to the portal and see how things work. So far, any questions on the presentation before we go into the portal? Let me see if I can extend the meeting duration. I have set it up 11:30. Still, I think it will end in 10 minutes. Anyway, so if the call is ended, please rejoin. So this is the portal. Can you see the Bond Bazaar portal?
I'm still seeing your slides, slide deck.
Yeah, can still see your presentation.
Okay, let me. Okay, I think I only shared a window, so let me change that.
So, Pawan, this is Praveen. So, actually, I've got the Demat account. So, do I need to go to buy
Yeah,
that
no,
bonds from that site, or I can?
no, so I will explain. So what happens when you register at this site, they open a Demat account. They have to open a different Demat account. You go to any bond platform, they will open their own Demat account with CDSL, which is Central
Okay.
Depository of Securities. So
So that will be the different Demat account for bonds,
yes, that will be
or I can use
different.
the.
That will be a
Okay.
different one. But when you generate a account statement from CDSL website, those listings will be shown in your Demat account. Can you see the terminal now, the portal?
Yes, yeah, we can see.
Bond
Yeah.
Bazaar. Okay, so this is the portal where this is dedicated for the bonds. So on the left side, if you see, this is a terminal which shows you the bonds currently traded on NSE. There is an option for BSE and RFQ. What is RFQ? I will tell you in a bit. Okay, then there are different things. This is your portfolio. What bonds do you hold for now? What are the orders that you have placed in the past? This is the IPO. So there are also IPOs in the bond market. Currently, there are no IPOs available, so you don't see anything here. Under IPO, you see three categories. One is corporate. So whatever private sector corporates IPOs are there, you will see it here. Then there is another tab for government issued bonds. So I think every Tuesday government opens treasury bills for issuance. So on Tuesday you will see treasury bills, and I think on Wednesday and Thursday you will see G6 government bonds available for uh, purchase under IPO. And these are sovereign gold bonds. Government hasn't come up with any IPO on HGB since I think several months, more than a year. So if they come up with some new allotment, it will be shown up here under IPO. Now, when we go to terminal, now let us take an example. There was one question about the interest. Now let's see. Let's take this example. IIFL Finance Limited. So if you open, you get all the information about this bond. So face value of this bond is 1000 rupee. I mean, when the bond was issued at the very first time through IPO, its face value was 1000 rupee, and coupon rate promised by this company was 9.6% at that time. It means that you will get 96 rupee per 1000 rupee every year, irrespective of your buying price. So on the right side, if you see here, they have given you the cash flow, future cash flow. Okay, so in 2022, total yearly interest is 95 rupee 95 paisa. So they are giving it on a monthly basis. This is a monthly payment frequency. If you see here, interest payment frequency is monthly. So they have split their interest on a monthly basis. So every month you will get 8 rupee 15 paisa or whatever it is based on number of days in a month, and that's how you will get paid a 9.6% interest. However, when you get this 96 rupee, if you are buying it at 1000 rupee, But now this is being traded in the secondary market. Someone has already bought for 1,000 rupee and now he wants to sell it to you. Of course, he will not sell it for 1,000 rupee. Okay, so if you go here, let's see what is its price. So now it is available. Someone is selling it at 971 rupee. Okay, so it means that you are getting that additional benefit. A bond that was bought at 1,000 rupee, you are buying it from 970 rupee. So if you do the calculations, the effective interest that you will get is 11.14% over the entire remaining tenure of the bond. So this is called as YTM, and this is something you should look for if you are buying from secondary market, not the coupon rate, because the coupon rate is on the face value of 1,000 rupee, but you are not paying 1,000 rupee, you are paying 971 rupee. So effectively you will get 11.14% interest on this bond. I hope this is clear, or is this confusing? This is something,
Very
this
much clear.
concept is a bit I mean difficult for people to understand. So like I get the questions why the coupon rate is 9.6, so why you are saying that it will give you 11%? Because you are buying it at a discount. You are buying 1,000 rupee bond at 961 rupee. That's why that is giving you an advantage. And if you calculate the cash flows, future cash flows, it comes out to be 11.12% of interest. So that is how it works. So Suhas, is this clear to you, or you still have any questions here?
Very much clear.
Yeah,
Just a question regarding this coupon rate and what was the previous one? I'm still confused between these two terminologies. I just understood that if you buy at like less than a face value like
hmm,
9.6, then you
hmm,
will get a higher return.
correct. Yeah.
That is the
So
only thing I understood.
so
But
what I will do, I will prepare a spreadsheet and will share with all of you, because what happens, say for example, today is 2025. Okay, so let me go here on the right panel.
Pawan,
Yes, Vijay. Yeah.
yeah. So in line with I think Suhas's question is like right now we are trying to buy a bond at 971 rupees.
Hmm.
Imagine had it been 1050 rupees or
Then
maybe even 11.
so your yield will drop.
Yes,
Yeah.
exactly.
Yeah.
So I mean, appreciate if you can just put some formulas with dedicated in that one spreadsheet. So we'll come to I mean better visibility
Yeah, absolutely.
how the
So,
calculations are being
so
made.
let me do it. I will have to put all the numbers here. So let me just try if the bond which pays on annual basis. So I will have to just put few numbers. So if you go here and if I want to search the bond which pays me interest annually, I can filter it. And let's say maturity less than 3 years. I apply it. So it will show you me the bonds which are paying me annually with maturity less than 3 years. So let's take an example, say REC Limited. Okay, now we are here in 2025. So let me open an Excel spreadsheet. So let me put today's date. And I'm going to get on 1st December, I'm going to get 73 rupee. Okay, so 73.80. Hey, can you hear me?
Yes.
And can you see my screen spreadsheet?
Yes.
Yes.
Okay, so sorry for this interruption. Okay, so on 1st December, I will get 73.80 on again yearly on 26.
So the yield and interest, that those are different parts, or what is?
So coupon rate is on face value. So what you should consider is yield, your yield. That is what really matters to you. Forget about the coupon rate because you are not buying. When you buy it in at the IPO level, your yield and coupon remains the same because you are buying value and your uh, face value are same. So that's why your yield and coupon rate becomes the same. But as that bond starts trading in the market, the price fluctuates, and that's why your actual return differs from the coupon rate. So you should be focusing only on yield to maturity, YTM. So what will be your actual yield till the time the bond matures? That is what one should focus on. So 1st December 73.80, 19 December 1000. Then again 3.64 interest. Okay. And today we are buying it. What is the purchase price for this bond? So if I, okay, so this is not, market is not open. So 1077 is the price that I am buying today. Okay. Now this is some time in between the year. So the actual interest of ITM might differ slightly. So let me just put the formula here. Sorry. So this comes out to be 5.53%, the yield. And if you see here, 5.54. Got it? So what happens today? You are giving 1077 rupees. So this is your cash outflow. That's why I have shown it in negative. And till the bond matures, this is the inflow, cash inflow for you. Right? At the end of the maturity, you are going to get back your 1000 rupees. That is the face value. The corporate will always return the face value because they had issued it at the face value. So you will receive 1000 rupee at the end of the maturity along with the interest on that small portion of the 19 days. So this is your cash flow that you will get, and this is what you are paying for that bond today, 1077. That's why if you calculate, your total interest or yield on this purchase will be 5.53%, and that is what is being reflected here. I hope this is clear. If not, then probably whoever has questions, we can discuss one-on-one offline and I can explain in more detail with more examples. Okay.
Sounds good. Thanks, Pawan.
Okay. Now, okay. So here, what you see, the interest payment frequency is annually. What type of bond it is? So it is a public sector undertaking, REC Limited. So that's why you see a little bit less yield on this because this is AAA rated, highly secure bond. The current remaining tenure for this bond is 2 years, 7 months. It will mature after this period. This is secured. Secured means what? If this corporate goes default, bankrupt, it means that they have their assets attached to this bond issuance. So if the SEBI or the authorities will sell their assets, and then the first owner of the proceeds from those sale of assets will be the bond holders. So secured means your money is secured against the company's assets. Then sector, in which sector this the company operates, date of maturity is given here, coupon type is fixed interest. You will get 7.3% fixed coupon on 1000 face value at the um, annual interval. Shut period is nothing but after this date they will stop trading of these bonds in the market. It's around 2 weeks before maturity. So when they stop trading, that is the SEBI regulation. Next record date is, this is the date that they calculate for interest payout. So whoever holds the bond on this date, which is 16th November upcoming, on that date whoever has the bonds, they will get the interest for that period. This is listed on stock exchange. Seniority is senior. It again means in this secured category, these bond holders are in senior category. So if anything happens to this company and their assets are sold, the senior category holders will get the payments first. This is a public issue date, date of rating, all these things are given here. Who are the trustee on this company and all those things, those details are here. On the right side, you see all the cash flows that you expect from this bond. So we are in 2025. The bond was issued sometime back in 2013. But if you buy it today, as we put in the Excel spreadsheet, these are the payments that you will get. Okay. So this is one thing. If you now market is closed, so I cannot show you how actually it works. But if you have to say, let me check buy. If you go to buy, you will see two options, NSE and BSE. So when market is open and if anyone is willing to sell, it's same, they have followed the Zerodha model. Okay, so you will see the bids and offers. Whoever is bidding for this bond at what price, what quantity, who is offering you the bond at what price, what quantity. Same for BSE. Okay, now if you want to place a buy request, the current yield is showing 5.42, but you can change it. If you want to buy it at a higher yield, then you can change it and it calculates the price automatically and it places the buy order at that price. So this is something you can explore if you register on this platform. If you can explore how it works and all those things. So this is all about trading on NSE and BSE platform. Any question here before we move to one more important concept of RFQs? Okay.
So NSE and BSE, so whichever is good, like
No,
both we can choose.
both are equal. You can choose the rates on both the exchanges, and whichever rate is best for you, you can go and buy from that platform.
Okay.
Okay. Now RFQ, what is RFQ? So RFQ is nothing but what happens now in the exchange traded bonds, someone has bought the bond in the primary market and they are selling it to you. In case of RFQ, now this portal Bond Bazaar, what they do the negotiations with the corporates and they buy the bonds in bulk and keep it in their inventory. Say for example, Bond Bazaar goes to Muthoot Finance and they say, okay, Muthoot wants to issue a bond for 100 crore rupees. So instead of going to different players, Bond Bazaar will talk with them. They will buy all bonds worth 100 crore rupees with some negotiated rates, which will be definitely slightly higher than exchange traded bonds. They will buy all the bonds in their inventory. Say they get a deal from Muthoot Finance and they buy the bonds for 10%. Then they will issue it to their clients, Bond Bazaar clients. And this is not only Bond Bazaar, this is done by all platforms, bond platforms. And this is the RFQ is the mechanism approved by SEBI. SEBI has bought this mechanism. So Bond Bazaar will issue these bonds to their clients with a better return than that they can get on traded exchange traded bonds. So how does Bond Bazaar make money? So they get the bonds from Muthoot Finance for 10% and they will offer those bonds to their retail clients at say 9.9%. So where that 0.1% margin uh, they will gain their operating money or whatever profit they make it there. So they buy in bulk and they offer it to their clients. So now RFQ, I'm not able to see anything here. Let me see if there are any filters. Okay, probably the market is closed, that's why, but it should still show. Okay, let me show here. Okay, so this is under RFQ category. If you see here on the top, RFQ, this is not traded on exchange. Okay, so this is RFQ. It means if you buy this bond from RFQ, you are directly buying from bond bazaar inventory. So what happens when you in exchange platform, what happens? You pay directly to the seller through exchange. Here you pay to bond bazaar through exchange again, and bond bazaar will be the seller who will allot the inventory to you and transfer it to your demat holding. The advantages here is you get slightly better returns than what is there on exchange traded platforms. That is the key here. Uh, Now what they have done, they have made some curated bouquet for their clients. Say this bouquet they have created, which gives you an income of approximately 10.75% if you buy this entire bouquet, which has IIFL and Muthoot Finance bonds, which are again AA rated with different maturities and different yields. So if you buy this bouquet as a package, you will get 10.4% as or your yield, and you place a buy request, you have to pay them, and then they will issue you the bonds. So this is how usually it works. Now the difference here is if you buy through RFQ, then it's your commitment, that because this settlement happens on T+1 basis. If you place a buy request today, you will get the allotment tomorrow. You have to pay the money by the next day. So if you make a commitment here by placing buy now button, and if you say that I'm not going to buy tomorrow, then they will ban you from this platform for 2 weeks. So that is what they are doing, because they see a commitment from you to buy from their inventory, so they block that inventory for you. Okay, and after blocking, if you are saying I'm not going to buy, so that's a, I mean, risk for them. They lose another customer because they have blocked the bonds for you. So that is one thing that they expect. If you really want to buy, then only place a request here. So that is something. RFQ gives you slightly better returns than other bonds. So that is what again I recommend. Go for AA triple rated bonds in RFQ category. That will give you better return. There is another concept here. I'm not sure why I'm not able to see RFQs here, but again you will see the same RFQs here. I showed you in those are being offered in a bouquet, but here RFQ you will see the bonds similar to what you are seeing in these terminals. Okay, but only those will be directly bought from Bond Bazaar platform, not from uh, exchange terminal. Again, it does not mean that they are bypassing exchange. All transactions happen through exchange only, because this is a SEBI. This process is bought by SEBI. Okay, so this is one thing, and there is another type of bond that they call as flexi bond, which shows up here once we see all the list of bonds here. So it comes here, one tab comes here as a flexi bonds. Probably you will be able to see it on Monday when markets open. It means that if you want to sell the bond that you have bought against the flexi category, then Bond Bazaar gives you a commitment that they will buy it back, because usually what happens in bond market, it's difficult, sometimes it becomes difficult to find buyers in the market. But in the flexi category, it's kind of liquid bond. They cannot call it liquid because of regulations, so that's why they call it as a flexi bonds. If when you purchase a bond under flexi category, at the time of purchase they give you a rate that, hey boss, if you want to come back after 3 months or 6 months and sell it to us, we commit that we will buy it back at this certain price or certain rate. So that is a commitment. In RFQ, you can, if you buy a bond in RFQ category, and if you want to sell it after 6 months, 1 year, you can sell it on exchange, as well as you can go back to Bond Bazaar and say, can you buy my bond? So they can help you sell your bonds, but they do not commit you to sell in RFQ categories. However, you can sell those bonds in exchange in open market. In flexi bonds, they commit to buy those bonds back. I hope this is clear, or it's confusing. This will become clear as and when you start exploring this platform, this terminology. This is not specific to this platform only. This is a general terminology, RFQ, Flexi, in all bond platforms in the bond market. So you will get to know as you try to explore these platforms and this market. So what I usually recommend, you go for RFQ. It's giving you slightly 0.2, 0.25% better yield than exchange traded. So that's where you get an advantage. That's again SEBI regulated. RFQ is the process brought by SEBI, I think in 3 years back. So you can try that. And this is how, and these are other features like bond bouquet. I told you they make some curated bouquets for clients, and they recommend you that if you buy this combination you will get this much yield and all those things. You see again the orders, IPO, all those things, whatever your transaction history, whatever orders you have placed, all those things you see here. And they are going to bring a tax model here very soon. where you will see all your investments, whatever is the capital gain that you have incurred on those bonds, whatever is the interest income. Now there are two things in the taxation perspective. Say for example, if you buy a bond at the bond that has a face value of 1000 rupee and you buy it at 900, okay, but at the maturity you are going to get 1000 rupee, okay, so that 100 rupees your capital gain. If you buy it at 1100, you get 1000 rupees, so 1000 rupee will be your capital loss. So in the tax, when you file the income tax return, you have to show it as a capital gain or capital loss. But whatever interests you are getting on these bonds, those should be reported as interest income, not as capital gain. So your tax consultant will be able to help you, but we will provide you the tax statement, whatever holdings you have, how much capital gain you have made on those, and how much interest you have on those. So that will help you to file your tax returns. So basically, this is what, in a nutshell, I had to explain how all these things work. I know some things might be confusing. We can connect one-on-one later also if you have any questions. So feel free to reach out to me and feel free to ask the questions now also. If anything is not clear, if you have any additional questions, please. So I hope I could at least explain few things, basic things in a better way. Any questions, please?
Yeah, Pawan, Rohit here.
Mhm.
I have a question. So, like earlier, you mentioned that maybe if there is a decrease in the interest rate, maybe due to some change in government policies,
Mhm.
uh, the demand for this bond might go up. Okay.
Correct.
So, in that case, the yield that I will be getting, so it will be on whatever premium price that I would be getting in that scenario, or it would be on the face value itself.
No, see, basically the yield is let me explain you in another way. See, yield is related to your coupon rate, but yield is, say, for example, your interest in the market is decreasing, and you are trying to buy a bond which is given you higher interest. Say government has reduced the interest to 7% and you are trying to buy a
Mm-hmm.
bond which is giving you 8%. Okay. So the
Mm-hmm.
person who is selling you the bond which is giving you higher risk, he will definitely charge you premium. He is not going to sell you at a lesser price, right? So if he has bought it for say 100 rupee, he will sell it to you for 105 rupee. Okay. It means you are
Right.
making a loss of 5 rupee at the purchase only. Okay, but you will
Mm-hmm.
get the periodic interest at 8%, which are higher than the current market price. So if you calculate all the cash flows in the future and you calculate the total percentage of return annualized, then that's what you get at the yield. So it does not mean that you are getting a yield on a face value. Basically, it is calculated based on your purchase value and the interest
Okay.
cash flows in the future.
Okay. Got it.
I can give you more examples later, a couple of examples with different frequencies that will help you to understand. We can connect offline for more
Sure.
detailed discussion on this topic.
Sure.
Yeah. Anything else, anyone? If there are no questions, what I will do, I will share a link for this platform. You register there and you start exploring it. If you have any questions, feel free to reach me.